Hi everyone. Okay, so now that we've had an overview of what a bank reconciliation is by looking at a picture of an actual working document, let's go back to the beginning and talk right from scratch about what bank reconciliations are and what they're for. They're a form of internal control. So we've talked a little bit about controls so that the individuals, the accountants, the bookkeepers in the company can keep an eye on what's going on and make sure that everything is working the way it's supposed to work. Things that are going through our bank account are supposed to be going through our bank account, and that we're recording everything in our company, in our books, in our T accounts that are supposed to be there. Okay. So the purpose of a bank reconciliation, as I've already mentioned, is to reconcile the two balances that we have that represent our cash. Our actual bank account statement that we get online from our bank, whether it's BMO, whether it's Scotia, or whether it's President's Choice, and then our book balances, which we get from looking at our general ledger or our T accounts for our actual cash account. Okay. So adjustments to the bank's balance on the bank reconciliation are listed to reflect timing differences, as I mentioned. So different things would be us making a deposit. So when we are getting ready, we, the company, are getting ready to do a deposit to the bank, we record in our system any cash that we've received, any checks that we've received. Then we make up the bank's deposit slip, which I showed you earlier in a previous video, and then we take it to the bank. Okay. And if the bank's closed, there's a night deposit slot where we can put our deposit and then the bank will record it the next morning. But of course, that creates the timing difference. We recorded it one day, the bank's going to record it the next day. Other things that are timing differences are, say, every 2 weeks we do a huge check run. Okay, and what a check run means is that we pay all of our suppliers that we owe money to. So we print off all of these checks, put them in envelopes, and take them to the post office and put stamps on them and mail them. You know, maybe we're not doing a lot of ETF yet because our suppliers aren't accepting it that way, still want manually written checks. So all these checks we've recorded in our system to show that we're paying our supplier, but when we put them in the post office or the postal box, they're not clearing our bank yet, right? The supplier needs to receive the check, then they need to do a deposit, and then they're going to deposit it into their bank, and then their bank is going to take it out of our bank. Okay, so it's quite a process, and it could take, a while, a week maybe. And that's why the timing difference. We just have to patiently wait for all of these checks to clear our bank statement. Okay, so that's why we create a bank reconciliation. And then, of course, there's things that go through our bank, such as service charges, or maybe somebody sent us an ETF, a customer, that we don't know that the bank's received it until we look at our bank statement. And then once we look at our bank statement, then we have to do the journal entry to record it. Okay, so that again is a bit of a timing difference. Okay. So bank balance adjustments, add we need to add in the unrecorded deposits. So again, the deposits that we've recorded in our T accounts through a journal entry, but we have to show that they're being added to an actual bank balance. And then we need to deduct off any outstanding checks. Think back to the picture that I showed you in the previous video. And then any adjustments if the bank made a mistake. Say they they were supposed to charge us $15 for a service charge, but they accidentally charged us $51. Okay, that's an error made by the bank that we have to tell them about so that they can fix it. Okay, so those are the three types of adjustments that would go on the bank balance side. So again, think of the picture I showed you of what a bank reconciliation looks like, and those are the three categories. Okay, so important tip, adjustments to the bank balance. We only adjust the bank balance for items that have to be recorded correctly in the accounting records, but by the date of the bank statement has not yet gone through. Okay. Okay. So another tip, this is just around language. Canceled checks means that it's cleared our system and cleared the bank, but an outstanding check means that it's gone through our system, but it hasn't cleared the bank yet. Okay. So book balance. Okay. One way to keep it straight, bank balance means your actual bank. Balance means your actual books. Okay, so this is bookkeeping course. So the book balance represents the balance that the company has by looking at the cash general ledger. So things that need to go through that could be adjustments that have already gone through the bank, but we haven't recorded yet are additions could be interest earned, if if a customer deposited money directly into our bank account and we didn't know about it yet. Okay, so we need to add those things in. And then deductions would be for service charges and any checks that bounced from our customers. So NSF, non-sufficient funds. So we thought we got paid by our customer, but when our bank went to the customer's bank to get the money, it wasn't there. So then our bank took it back out again. So now with an NSF check, what we need to do is get a hold of our customer and say, look, your check bounced. You need to send us a new check or you need to give us cash or actually an ETF and then it goes, sorry, an EFT. ETF is something else. EFT, electronic funds transfer, and then we know for sure that we have the cash. Okay. And then any adjustments for errors so that if we see that it's gone through the bank, but we look at our books and we see that they don't match, but all the other details match, maybe the bank put something through $210 that a customer paid us, but we recorded it as $120. Okay, so that's our mistake. So we have to fix our mistake. So this is, in words, what our bank reconciliation looks like. Okay, you've got the bank balance adjustments on one side and the book balance adjustments on the other. And if we had dollar amounts in there, as you know, we'd have the opening balance just above those adjustments. If you think, again, think back to the picture that I showed you in the last video. Okay, so steps in compiling a bank reconciliation. Okay, so what I'm going to do, because I think I'm going to run out of time, is I'm going to stop this video. We're at the 9-minute mark, and I will create another one to go through all of the steps in compiling the bank reconciliation.